Hey there, it's Ben and Adam here from Pumped On Property, and in today's video we're going to explain what a mortgage broker actually does. So we're going to give you a bit of a peek behind the scenes and talk about exactly what they do and exactly how they can help you. So Adsy, before he started here at Pumped On Property, was actually a mortgage broker with one of the biggest companies in Australia. He's got heaps of behind the scenes tips and tricks to help you get access to better finance and get access to better brokers. So I'm going to throw it over to you, man. What are we going to really talk about in today's video, just as a bit of a snapshot?
Thanks, Ben. Hey guys, Adam here. So really we're just going to be talking a little bit about what a mortgage broker does. Now, it's a bit of an overarching topic and you can really kind of go into the nitty-gritty, but what we're going to focus on is the fundamental ways that a mortgage broker should be able to assist you with your, say, your property investment strategy or your goals, or even just your journey in buying your first home.
Awesome. So I suppose in terms of we're breaking that down, there's going to be 7 distinct things that the mortgage broker does. I don't know why I just put up like 3 fingers when I'm saying 7. Standard. Adsy's like before the video, what do we do with our hands, man? I'm like, I don't know, dude. I just do weird shit and then get YouTube hate. But you know, like, we're going to talk about 7 different things that a broker does. Why don't we kick it off with number 1?
Yeah, no worries. So this is basically the overarching topic, and it's they review your financial position. Now it can be broken down into smaller steps, and they obviously aren't a financial advisor, so there's limits to what they actually do. It's more so from a lending point of view of how they assist. But obviously, as anyone who's bought property before would be aware, what you can borrow and how much you can spend based on what the banks will let you is a very important part of that process. So I guess to kick it off and go straight into number 2, the first thing of doing that is really checking your borrowing capacity. Now, brokers like to work in different ways. Some might like to focus specifically on, say, just having a conversation, going through all your information and really trying to help you out. Others might be a little bit more geared towards getting you the loan, which could be, say, asking for those documents a little bit quickly, or a bit quicker, sorry, and what that allows them to do is then not give you information that might be wrong, and it allows them to do a full assessment, like we were talking about in step 1, of your situation, instead of talking about ideas up in the sky that might not actually be practical for you, depending on what your situation is. So I'll jump straight into number 3, if that's cool, Ben, or do you have something to say on that?
I just wanted to add one thing to that. So some of the brokers just, you know, have a session with you for half an hour, build a bit of a relationship with you and ask some questions and then jot them down. Others, like my broker, who Ads worked with, was more like sending me just through a health check, basically a where are you right now financially check, and then he'd just send me another list of all the documents that he needed from me. I'd just send him the email back with my little list, as well as all the attachments like the statements that he needed and the rental statements and things like that for the different properties, and then that would enable him to have everything that he needed up front to be able to look at the position and then just start deciding who the best lender for me is, which we'll talk about in a moment. But you know, either way you're going to get to that point, and I think the best thing you can do to work in with your broker in the most positive way is to just be respectful of their time, give them the information they're asking for as soon as possible, and don't be like 90% of people, and that is, you know, just waste your own time and their time by drip feeding one little document at a time to them.
Yeah, and obviously I'm a bit biased in that opinion, and I'm a fan of the way that your broker did do it, and I was working him, and it was a system that I thought worked really well. So the reason we split it up into 2 was, or Aaron split it up into 2, is that what it allows him to do is do a first initial check and get a good overview or overarching view of what your position is, and give you a bit of an idea of, say, what your borrowing capacity is before asking you for all those documents and expecting you to kind of put a little bit on your end. But once he's done that check, or once a broker's done that check or had that first conversation, it's really important, like Ben said, to get those documents together and get them to them as quickly as possible. That's what really allows them to do the real check of what you will be able to borrow with a lender, and that's what should give you confidence on how much you'll be able to borrow and start making decisions and thinking about what that right property would be and what that right price point would be.
Yep, so your broker, I think, is probably your most important ally outside of a good accountant and a good solicitor in terms of that team of advisors you're looking to build. So, you know, once the broker's got all of that information, you know, what is part 3, this performing a full assessment thing?
So it's basically, they'll take all the documents that they've requested. Now, these documents might change depending on your situation. So if you're self-employed, that could mean tax returns. If you're full-time, that could mean pay slips and PAYG summaries or group certificates. They'd like to generally see all the documents that might pertain to any, I guess, financial commitments you have at the time. Now, obvious ones are your credit cards, personal loans, car loans, anything like that. But it could also mean if you have, say, a separated family and you might be paying child support or something along those lines, they do come into account as well. Now, there is also HEX, a few other things. We won't get into too much detail with that right now, but yeah.
It's fun stuff, guys, all that debt.
It's basically trying to be, I guess, as honest as possible and transparent with your broker to get all that information out to them so they can make a smart choice, and it doesn't require them to, I guess, go through your documents with a fine-tooth comb to find these things out themselves. Just remember that a broker's always working on your behalf. Even though they do get paid by the bank most of the times, they're still working for you. So make sure you have a broker that you trust, and yeah, trust in that relationship and try and be as transparent as possible.
Yeah, now one thing I want to touch on before we move on to point 4 in terms of what a broker does is just this concept of the way that money moves with the economy at different times of the cycle. And why I'm touching on that is right now, as of 2018, it's pretty difficult for some people in the market to get money. Those people are generally people with a bunch of properties, or people with a lower income, for example, or people with a first or second year business. But then there's other people in the market that this lending criteria really supports, like first time buyers, like people with their own home that have good equity in their home, like people with good incomes with low debt. So at different times of the cycle, I remember when I was first getting started in 2011, it's probably why they're doing a banking inquiry now, because they were just writing loans for absolutely anyone, and that's obviously what kicked off the Sydney and Melbourne bull rush that we've just gone through. But the reality is, you know, at that time you only needed a 5% deposit. I knew people that were putting down 2.5% deposits that didn't have to pay lender's mortgage insurance or got that added to the loan, that got its stamp duty added to the loan. At that time there are 100% loans. You know, sometimes people weren't even putting down money. You know, and after a GFC like that, there is easy credit available and everybody in the world can sort of get loans. And then at different times they tighten up the system because it gets a little bit out of control and the speculation gets a bit too hot, and they tighten it up so that not as people can buy. You know, it settles the market like it's had a cooling effect in Sydney and Melbourne at the moment. And then I can guarantee from about 2021 we'll be completely off to the races again, and money will be very easy to borrow again, and that will kick off the second half of this whole thing.
Yeah, and just to touch in on that, some lenders still will allow you to borrow with a 5% deposit and capitalise that LMI on top.
That's right.
It's just the interest rates might not be quite as attractive as what they once were, and from memory, they weren't that great at the time either. It was just a little bit easier for the motivated investor to keep kind of pushing that boundary, whereas that's really what APRA's kind of tightened up in those last couple of years. They wanted to slow down that investor a little bit, but it is slowing them down a little bit just to kind of manage that risk. So when you look at the figures, it really is just a risk management point of view from them. It's not trying to stop mum and dads from investing because they think it's a bad idea. They just want to make sure everything balances out and they're not putting the property market in a position where it could potentially dive or could potentially be their fault or the financier's fault that's how that happened.
No, that's such a great point, man, and completely true. I remember when I was first getting my loans in place, I thought a great interest rate was 6.5%, 7%.
Yeah.
This is, you know what I mean? Like, now that I look at rates at 4% and stuff like that, I remember you had clients that are like, I'm not going to sign off on a 4.5% interest rate because I can get like a 4% rate, and I'm just like shaking these people. I'm like, you're going to miss out on all of this capital growth potentially in the right market, or all of this cash flow from the rental return to try and save yourself 0.5%. I'm like, this is crazy, ridiculously low interest rates that Australia hasn't really experienced for this prolonged period of time forever. And you know, you're worried about that when we used to be paying 3% more on everything not that long ago. So, you know, just take it all with a grain of salt. Obviously, don't invest in anything if you're not in a financial position to do it. But if you're sitting on the sidelines waiting for rates to dive or holding out for 0.5% cheaper at the expense of owning a great property for a few years, you've really got to be considering that as well.
100%, and I think that's always worth weighing up. And I guess it's any sort of investment, you want to look at that return on investment, and it simply means that those ongoing costs might be a little bit more to hold on to the property. But if you do the figures and it still stacks up and makes sense, then I don't see why you wouldn't be wanting to take advantage of that that situation, even if it is a little bit higher than, say, what you've seen advertised online. And just to jump in there really quickly, when you do see those really cheap interest rates advertised online,
they're baiting rates, they're not real most of the time.
They are real, but they're real for a very specific client exactly who they're looking for in a very specific position. They might limit you on what security you could buy, what sort of job you're working in. Like, it goes on, and you can get those rates with those lenders, but they may go through you with a fine-tooth comb, and 9 times out of 10 it generally jumps up to a higher interest rate once it's all said and done with those guys anyway.
I've personally, a couple of years ago, I think in December 2016, just before Chrissy, I found a really, really decent property about 10k's from Brizzy CBD. Actually, my sister found it for me. I literally bought it that day. At the time, I couldn't get the rate that I was looking for. I had to go with one of the second or third tier lenders with a higher interest rate. I think it was 5.5% at that time. A year after I bought it, there was some equity in the property because I bought it at a good price and the market had done okay. And so I've just refinanced it back to one of the big 4 lenders at a rate that's literally 1.5 points below where I was at. So there's always that option too, to get the run on the board and then refinance to a safer, lower rate option in the future if you're in a financial position to be able to do that. So
exactly.
Let's slide into part 4 now.
Yeah, so we've already kind of touched on it a little bit, and they'll come in to help you find that lender that is most suitable for you. So it's not just a matter of, like we touched on, looking across the market and going, this is the best possible interest rate, this is what you're getting. There's other things to take into account. So if you are trying to access equity in the future, is that going to be a process that they're going to have to facilitate, or are you then going to have to refinance to make that happen? Now, generally we can try and get back costs in refinancing, but it is a process you have to go through then to try and access equity. So it's worth thinking about. If you wanted to do a dual occupancy property, that's also important, because not all lenders will do that on the same products and the same rate. So there's other factors that you've got to think about in this. So what a mortgage broker would typically do is get all of your information, and once they've got every piece of information they know that they can confidently submit an application on your behalf, that's when they can go away, look for a lender, or look across the market at lenders and find who they think would be the most suitable. And trust me, they're looking to get you the best price as well. There's no incentive with most brokers to put you with someone on a higher interest rate. It's just not the case. They want to get you the best possible loan with the best possible outcome. Now, some people might get frustrated that's not the cheapest rate, but trust me, if you're waiting 4 weeks sometimes just to get a response from someone because you want the cheapest rate, that's a much worse experience for you than, say, getting 0.05% better and saving yourself $50 to $100 over a year. It's just, you got to kind of think about these things logically at different times and weigh up whether that difference in interest rate's important to you. And to go back to it, just trust your mortgage broker. If they're suggesting someone in particular, they've usually done the research, looked across the market, and that's who they believe would be the best lender for your situation at the time.
The thing about having a great broker, now, I know there's a whole lot of stuff kicking off at the moment about this banking inquiry, and the banks are pointing fingers at brokers to sort of dodge all the bullshit that they've done themselves, I think. But a great broker really should give a shit about you, and not just about getting the loan in place, not just about the financial benefit of obviously getting the loan in place, because they are people like you and me that need an income to survive, but they should also be looking at that longer term picture with you and asking some questions around, yes, this is where you want to be now, but where do you want to be in the future, and how can I structure in a way that gets you what you need today, but also is thinking about that long-term perspective, which I suppose takes us into point 5, which is preparing and submitting the application.
Yeah, so I think you've jumped ahead a little bit with that one, something I'd like to touch on in point 6, but point 5 is what we really want to say is they'll put together the application for you, they'll do the paperwork, they'll do all those little annoying things to make sure it's all right, make sure it'll have a seamless transition through the banks. Now, when I say seamless, it's not always so seamless these days, and you can't be too hard on your broker about that, because it is a dynamic environment that's constantly changing. So you might have a condition that's put on you from one assessor this week, and then 3 weeks time you can go to the same bank, get a different assessor that might look at it in a completely different way without any regulations even changing or any of their rules or guidelines. And then on top of that, there's also constant guidelines changing. So say at Mortgage Choice, we had access to over 25 different lenders. If you're trying to stay on top of those 25 different lenders and every little change, it's something you can do that you might be confident you can definitely get that person a loan, but there might be a document or two that may need to be resent in or may need to be updated to help that process go through.
Yeah, you know, one week the same bank could be looking for baseline information, the next week it could be baseline information plus like a couple of your children and some of your blood type thing. Like, these guys want a lot of different things from you, and you've sometimes just got to bend over to give it to them. So, you know, let's hook in from there.
Yeah, so jump into number 6.
Number 6.
Yeah, so what Ben was touching on before is a broker, although they're not a financial advisor or planner, they can help you get an idea of what you'll be able to borrow in the future. So they could put in a situation that, say we're looking at our strategy at Pumped On Property at the moment, or one of our most popular ones to do 2 properties and 2 granny flats. They can look at how that situation will play out. Now, regulations change, conditions change in the market, so it's not locked in and things could drastically change. And I've seen that over the years I was working with Mortgage Choice. Unfortunately, some people, you had really high hopes to borrow a lot of money at a point in time, could be drastically reduced a few years later, which can slow you down. But like Ben says, tends to go in cycles, these things, so it does come back around. But it's just worth pointing out that they can go through that process, they can have a look for you, give you an idea that this is what we need to look at, and it becomes important when you might be looking at, say, purchasing a $700,000 property for your first one, but that's using up a lot of your borrowing capacity. Whereas there might be the avenue to drop it down to, say, $450,000, which then facilitates you doing that next property sooner, as long as you can do the savings and cover those other aspects.
Yeah, so again, a good broker is going to blend in with your strategy. Sometimes for some people, one very high quality property closer to the city or on the beach can be a great option. For other people that are looking to do different things, a couple of properties with a couple of granny flats on them can be the solution, or everything in between that. So it's really about matching where you want to be personally in 5, 10, 15 years from now with where you are right now and what your opportunity looks like, as well as the opportunity cost of not taking option, and then trying to find a balance between that, which for every single investor I've ever met is the tricky point, the balance. I remember there was a period of time in the last 8 years where I literally couldn't get a home loan for 2.5 years, and that was very, very frustrating as somebody who wanted to move forward faster. In fact, out of the last 8-9 years that I've been doing this personally, I think most of the time I haven't actually been able to borrow any money. There's been very limited amounts of time to do that, and when those opportunities come up, that's when you really want to have a great strategy in place, a great team in place, and, you know, good knowledge of the marketplace so that you can take advantage of that opportunity while it is there for you.
Yeah, 100% agree. And just to touch back on that slightly as well, it's kind of a bit of out of the loop what we want to talk about, but I think that highlights the importance of getting a pre-approval as well. So like Ben was saying, there's large times in his life where he wasn't able to get the perfect loan or with the lender he wanted to, but he did put himself in a position to take advantage of those opportunities by being pre-approved with, say, a specialist lender or a third-tier lender. But it allowed him to make that move if that right opportunity where all the figures did stack up, which I personally think is a very important part in the process. So if you're kind of wondering whether you're going to go ahead or not, and kind of delaying having this conversation with a broker or kind of going through the process, it's no harm to get up to that pre-approval stage, and at least it puts you in a position where you can jump on that right opportunity when it does arise. Because
you don't pay anything to the broker most of the time, they're free, and they're doing all of this amazing work for you behind the scenes. Obviously in that first session they're going to tell you basically it looks like you might be able to do something or you can't, and then from there, if you can't do something, you can go back and say, well, you know, what do I need to do to get my position in a position, like self in a position, myself in a position where I can, you know, potentially borrow in 6 months, 12 months, a couple of years from now. But, you know, your job is just to blend in with that and take advantage of market conditions when they come up. Often at times when a lot of people are sitting on the fence, waiting to see what happens, or when the doom and gloom comes out, there can be some of the best buying opportunities in a lifetime. And, you know, sometimes when everybody else is buying in an area, it can also be the wrong time to be considering something in that place. So, you know, it's about understanding property fundamentals and then making sure you've got money to take advantage of those fundamentals as they come up. 100%
agree with that. I guess just to wrap up, I'll touch a little bit on I guess what else a mortgage broker can do for you. So we've talked a lot about at the, like say, the start of your investment journey or when you're looking for a property specifically, but they can also assist in just helping you with your current loan situation. So a lot of brokers will have access to personal loan providers, car loans as well. So they may have some capacity to help in that regard, but mainly with your home loan, they can perform a health check on that loan. And it's not as fancy as it sounds. It's basically what interest rate you're on and what are your fees. Let's have a look at the rest of the market, see if that is a better interest rate or a better savings to what you're on right now, and is it worthwhile making the move. So there is some cost to refinance across, but generally if you can recoup those costs in the first year or 2 years, it makes sense to refinance to someone else, especially if it's getting you on a better rate, a better deal, or putting you in a position where you say might be able to move forward with that next property purchase sooner.
I love that, man, because you know it might only sound like 1%. I know there's 70% of the investors sitting out there in the marketplace right now that bought anywhere in, you know, any further back than the last year are probably paying a higher interest rate than they need to be right now. There's a lot of opportunity in the current market because there's not as many investors, not as many buyers, where these banks are looking for money and where these lenders are looking to write loans, and therefore they're competing on price and rates, which can be a great thing. Like if you think you've got a $500,000 home loan, for example, in terms of the debt, 1% on 500K, just 1% difference is $5,000 or $100 a week that you're paying out of your pocket. If it's a 0.5% saving, it's $2,500 a year. Now, I recently redid this myself because at the time I think I had 7 or 8 properties. I've sold a bunch of them down now, but I went through this process a little while ago with my lenders, and I literally just called them up and I talked to my broker, and I ended up saving myself literally $27,000 a year in interest. I didn't even know that I was fucking paying across all of these properties. So, you know, not everyone owns that number of properties or has that amount of debt, but they can be huge savings. And in some instances I was paying 1.5% more on 600K loans than I had to be. It is absolutely absurd and crazy. You know, one of the other tips that I found recently was interest only loans were attracting a much higher percentage interest rate than principal and interest loans, and so I was in a position cash flow wise where I could afford to go principal and interest, and that was in itself like a $16,000 saving. Now, yes, it's costing me more week to week, but I like to buy properties, as you all know, that cover themselves in terms of the rent after costs and before taxes. So it's not killing me to start paying down these debt, and while I'm not doing anything else, it's building great equity into my portfolio anyway.
Exactly. People think of it when they think principal and interest repayments that no, like there was this real, I guess, drive that everyone wanted interest only repayments, hence why this change has happened, because it's always seen coming through. Every investor wanted interest only repayments, and it makes sense from a cash flow point of view, but if it's costing you more money, I'm with Ben. Refinance to principal and interest. As long as you've got the capacity to put those extra funds into the property, you're not losing that money. It's generating equity by paying down the loan. So it's not lost money. It's just simply a requirement to sit it somewhere else for a little bit. And I know that loses some flexibility or freedom with future choices, but to be honest, it's quite easy to get cash out this day and age, and as long as you're not using it for expensive toys like getting a new jet ski or a boat or something, and that's going into an investment property or an asset that you value, it can generally be done in a way where it's not going to impact you in a negative way to get that money out and do it, whereas otherwise there can be some issues with your tax, but that's something obviously best discussed with an accountant.
For sure, guys. So I hope you've got some insight into what a mortgage broker actually does in today's video. You know, a lot of the time they keep it pretty high level. A lot of the guys in the finance industry like to sort of keep the curtain pulled back so that nobody can really see, but hope you've got some ideas around what they can do. A great broker can really help you, you know, not just understand where you are or where you're looking to go, but help you take the right steps in the right way to actually really set up your future, because ultimately the reason you buy a property is to become financially free at some point in the future, so that you, your family, have choices to lead the type of life that you want to lead in the future. So thank you so much for your time and attention today, guys, and can't wait for the next video.
Thanks, guys. Enjoy.